Hey friends, how's it going? Now you may be wondering, is the government going to do a total shutdown in the middle of the pandemic? And what about the market, right? Happy Thursday, my friends. Thanks so much for joining me. We are live and I'm excited to be part of today's live level up conversation with you.
Welcome to Level Up with Winnie Sun.
Well, hello. I'm Winnie, your host, Forbes contributor, CNBC council member, and award-winning financial pro, here to keep you on top of relevant, trending business news. And of course, talking about the market too. But most importantly, remember that you're part of today's discussion. So we are live, and that means that I'm actually going to get a chance to monitor your comments, your questions. So let's start off, have some fun. Definitely join me. Don't be shy. Let me know where you're joining us from. Of course, happy Thursday to you. Want to start off and say hello to CrossX Fighter. Hello, Joshua. Hello, Vicky. It's great to see all of you joining from all different parts of the country. Always a hit. Actually, not just in the country. I know Vicky is joining us from the UK. So thanks so much, all of you, for being here. Now, today we're going to start off with the question. We're going to start with the market, I should say. We're going to start with the market, and then we're going to jump in over to your questions, because today we're going to continue on to doing Ask Winnie Anything. Many of you have submitted questions, and I want to make sure that we answer them on a timely basis. So thanks so much for doing that. But first off, let's start with how the market closed today, because you're going to actually want to hear this. This is actually some positive news, my friends. Now, you may have seen earlier this week, the market pretty much tanked on Monday. It was pretty bad. But today, market definitely recovered quite a bit, continuing on the uptick from yesterday. The Dow closed up 506 points. The Nasdaq closed up 155 points, and the S&P 500 up 53 points. So positive across the board on all three major indices, as the U.S. stock market jumped for the second day, as fears around the crisis, with China's their big financial real estate conglomerate. We were very, very concerned, but some of that has eased a little bit. People are sort of breathing. And more importantly, people are really optimistic of what came out of the Federal Reserve yesterday, of them keeping the current monetary stimulus plan in place for the time being, at least. Now, yesterday, Fed Chairman Jerome Powell, you may have seen this. Well, they ended their two-day Federal Open Market Committee meeting with, a discussion on how we are standing currently financial-wise and what they're going to do for us in the near future. Now, it's not too much of a surprise here, in that you probably expected that there weren't that many big changes, right? Nothing dramatic just yet. They're going to keep interest rates pretty much plus or minus about the same right now. Jerome Powell said yesterday, we're okay with leaving rates where they are currently, but in the near future, probably they will start to increase. They also talked about bond purchasing policies and how that was going to take place. Now, however, the Fed continues to prepare the market for a reduction or, a taper of bond prices. We still think that the Fed will continue to provide monetary support to those of us here in the United States for our economy for at least a few more years to come. So as you know, 4 times a year, the Fed actually updates its economic projections for the next several years, as well as its longer term forecasts. So you might be saying, well, what's pulling at the economy currently, right? Certainly you continue to hear about the Delta variant. We hear about hesitant workforce. People aren't really ready to go back to work as it used to be, like pre-2019, right? Work is definitely not the same. And we're also dealing with a lot of supply chain issues of just not having as many material goods, not having the labor force to be able to get things done and get things sold and get things shipped out. And so that's causing a lot of supply chain issues, which then translates into the big, ugly I word, which is inflation. So this is impacting both inflation and the GDP growth for the rest of 2021. So the Fed now sees about just shy of 6% in GDP growth in 2021, which is down from 7%. So they're expecting about 5.9% GDP growth, down from 7% in June. And they're expecting much higher inflation versus previous years. We've talked about this before. Typically, we like to see inflation somewhere between between 2.5, maybe 3% at most. But right now, the numbers are looking at anywhere between 3.5, 4, and maybe higher. So the committee has noted that they definitely see inflation falling slightly in 2022. But that's really quite optimistic. But they anticipate also a pickup in economic growth for the end of the year and hopefully into 2022 as well. So I don't know how you feel, but we'll take the good news when we can get the good news, right? A big hello also to Robin Stevens joining us on Twitter Live. Hello. And Sadiq joining us from LinkedIn Live. It's great to have you with us. And those of you, I've seen many of you joining. Oh, from South Africa. Wonderful. I'm not even going to try to pronounce your name because I don't want to be rude and mispronounce it. Welcome to the show. It's great to see all of you today. Now, let's talk about this. And this is actually big news because I was like, really? In the middle of a pandemic? Could the government be shutting down here in the United States? Well, the answer is a strong maybe. Because the U.S. government has a September 30th deadline to pass an appropriations bill before the government funding lapses. That's right. So the White House today began to advise federal agencies throughout the United States to prepare for the first government shutdown of COVID-19. We're in the middle of a pandemic and the government might shut down. How crazy is that? Absolutely crazy. Mind-boggling. So hopefully they get this straightened out because government officials today are working really, really hard, hopefully, to try to meet several deadlines that will affect both the health of the United States economy and economic plans going forward. So, hopefully this will take place because September 30th, as you know, that's exactly a week from today. So let's see how that will unfold. Definitely something you and I will be paying close attention to, for sure. I'll keep you updated here on Level Up, of course. Now, on other news, I would like to know, those of you who are watching, do you also feel like you pay way too much in taxes? We got to talk about this. This is a big thing. And this is actually front page news here on CNBC. Big news. Well, if you feel like you pay too much in taxes, first of all, raise your hand. You're not alone. And you're probably not one of the top 400 richest families here in the United States either. I'm not part of that either. I feel like I pay too much in taxes. Well, today, CNBC shared that the wealthiest 400 American families paid an average of 8.2% on their federal individual income taxes from 2010 to 2018. This is according to a White House analyst report that was published today. Now, in comparison, to give you an idea, Americans paid an average of about a little over 13% tax on their income in 2018. Also, according to Tax Foundation analysis. So why is it that they pay so much less percentage-wise than the rest of us do? So I thought I would talk about this a little bit because I read these articles, you read these articles, you probably heard the headlines and you're probably like, why am I paying so much in taxes? If they're paying so little in taxes, the Elon Musks, the Jeff Bezos, the Mark Zuckerbergs, these guys are definitely not paying as much in taxes as we are, right? Well, one of the reasons is this: investment income. Now, we know that the wealthiest Americans tend to, what do? They tend to invest a lot versus regular middle class, lower middle class, even lower class. Usually we pay taxes on our income tax from wages, from our jobs, from our income, right? In contrast, the wealthiest Americans generally generate a lot of their income from their investments, which, as you know, with capital gains, if they hold these investments in excess of 1 year, 365 days, right, they're generally taxed at a lower rate than wages. So the top federal income tax rate for wages is currently at 37%, while the top rate on capital gains, which would be on dividends and assets and whatnot, if you hold them for more than a year, is about 20%. So a very dramatic difference. So these would be gains on things like stocks and bonds and real estate as well. Those are short-term, long-term capital gains. Those are capital gains versus income. So this is really interesting. I mean, Sadiq is saying, how much has Jeff Bezos paid? I don't know. I'm sure that's out there somewhere. I didn't do the research, but that's a good question. But I will guess that percentage-wise, he probably paid less than many of us here on the show today. Who knows? I don't know, but I'm just guessing. But let's go have some fun today because we promise you a continuation of Ask Winnie Anything today. All right, friends, this is always a fun time. I love it. I appreciate your questions coming in so much. And as a reminder, before we jump in here, if you have a question, you can do the same thing. You can send it to me via our website at levelupwithwinnie.com, or you can jump on whatever platform you're watching me from right now. Go and send me a message, tag me on your question, or send it to via the direct message box or mailbox, whatever it is. And that way I can get your question, because we got to answer your question, because sharing is caring, and your questions help so many people, especially those of you who are watching today. Let's talk about the first question. All right, so this was a question regarding tax harvesting. This is a good one. I was reading about something called tax harvesting your portfolio. What is this, and how do we go back taking a proactive approach? Now, this is perfect. This is like perfectly timed, because I actually didn't time this. It worked out really nicely, because it kind of segues to our discussion just earlier of how the 400 wealthiest families pay less in taxes percentage-wise than most of us here. Well, there's something called tax loss harvesting that I want to make sure is on your radar, because as we prepare for the end of the year, we're looking towards Thanksgiving, Christmas, the different holidays, and maybe you're just excited because the holidays are coming and it's getting a little colder. Maybe wherever you are, you're getting some snow. We don't have snow here. But that being said, there's a lot to be looking forward to, but there's also a lot that you can plan for financially to set yourself up for a better 2022. And one of those is really paying attention to something called tax loss harvesting. For those of you who own stocks, bonds, investments, maybe real estate, this is something you'll want to pay attention to. As a strategy, tax loss harvesting involves selling an investment that has lost value. So maybe you bought something a month ago, maybe you bought something a year ago, maybe 10 years ago. If it's lost value from the time that you purchased it, well, you could sell it now, and then you could then replace it with a similar investment, and then that way you've taken the loss. You're able to write off that capital gains loss versus any gains in the future. But you're also able to now kind of rebalance your portfolio. And if you still like that industry, let's say you're buying something, let's say you're buying something in the tech industry that's at a loss. If you sell it and you buy a different name or different company still in the tech industry, you could buy it the very next day. And then that way you're able to take that loss and you can still invest in that industry. That's called tax loss harvesting. And it's a really important strategy. And those of you who work with financial professionals, you probably heard about this concept before. And if you haven't, then it's something for you to think about. Now, keep in mind that this doesn't apply to accounts that are what we call qualified accounts. Now, qualified accounts are generally tax sheltered accounts. So this will be accounts such as your IRA or your Roth IRA, your 401k at work, maybe your 403b, your Roth 401k, things like that. Maybe you have a SEP IRA if you're self-employed. These types of accounts, because they have tax benefits, or tax sheltered or grow tax free, usually you're not going to be able to utilize these sort of accounts or the investments within these accounts as part of your tax loss harvesting strategy, if you will. But if you have any questions on this and you're wondering how you can take advantage of this, I strongly suggest that you do right now. Reach out, send an email to your accountant or your CPA, and certainly your financial professional, and say, hey, I have a question on this. Is there anything I can take advantage of in terms of tax loss harvesting to set myself up better for 2022? So great question. Thanks so much for asking that. I'm hoping a lot of people benefit from this answer. But let's go and move to our next question. Okay, this is a great question too. Thank you so much. Okay, hey Winnie, my parents don't have an emergency fund, but they do have retirement. Is there a way for them to use that investment as also their emergency fund? Okay, great question. Now, actually, I've talked about a lot of this recently. I actually had a chance to talk about retirement on Yahoo Finance just in the last couple weeks. And here's what you want to know. Now, when it comes to retirement savings, what is it really earmarked for? For retirement, right? So depending on how long you have between now and let's say early retirement or like final retirement, you may want to just keep your retirement savings plotted there, left there for that sort of goal. Now, if your time horizon is shorter and maybe you'll have to retire sooner, that could change things, right? Depending on how you're invested. Is it in a 401k? Is it a Roth 401k? Is it an IRA or SEP IRA? It depends on the structure too. But here's what you'll want to know. If you are limited in terms of resources, but you haven't saved up for your emergency fund and you utilize your emergency assets for that emergency, take a look how it's structured. For example, if you have a Roth IRA, this can certainly serve as a dual purpose if you don't have that much to save, but you really want to take care of those important financial goals. So the Roth IRA serves very well this way because, as you know, monies that you contribute into a Roth IRA are typically going to be accessible to you at any point in time for any reason without penalties and without taxes. So let's put that in context, right? So let's say you have a Roth IRA, you contribute $5,000 to it, and it grows to $8,000. Well, the $3,000 versus gain or your profit on your Roth IRA, you don't want to touch that. You want to leave it and let it continue to grow long term. Because if you do that and you keep it in there until age 59 and a half and beyond, so let's just say age 60 and beyond, then that money that's grown in that Roth IRA, 100% of that comes to you without taxes, without federal, state, local, AMT, all that craziness. No taxes due as long as you keep that money invested at least until age 59 and a half or rounded up to 60 and beyond, right? That being said, what you contributed, which was originally that $5,000, you don't want to take that amount out. You want to leave that $5,000 in there if you can, unless it's for an emergency. Now, if it's for an emergency, that $5,000 which you put in, you can take out without penalties and without taxes. But again, if you wanted to put it back in, you would have to put it back within 60 days or less. So generally speaking, your retirement account should be left as a retirement account. Unless it's absolutely emergency, then the Roth IRA could be a good option for that. Now, on other questions pertaining like distribution, how to best utilize your money, I strongly suggest you set up a time to put together a really good financial plan, a good retirement plan. This is the best time to do it. At the end of the year, there's a lot of things that you can be deciding on and money moves that you can actually take advantage of now so that you're better prepared for 2022. In fact, I'm actually working on a seminar right now. I'm excited because once I'm done with that, I'm going to be sharing it with a lot of companies and their employees, getting them up to speed, getting them ready for next year. So good question. Great question. Hopefully it was helpful. So definitely do that. I mean, when you think of emergency fund, of course, if you have the money to do so, a separate emergency fund is always ideal. If not, you want to look at the least painful way of utilizing your own money. That could be in the form of maybe a home equity line of credit against your house. It could be in the form of your checking account. It could be in the form of borrowing from somebody that you trust, that trusts you, that can lend you just something short term. We're looking at ways to be able to get some money to solve your problem quickly without paying too much in taxes and certainly not too much in interest as well. So thank you so much for that question. And thank you so much for being here. And thank you so much for watching, supporting our program. Take a moment, if you can, to share this show with someone that you care about. And as a reminder, you can find full episodes of Level Up with Winnie Sun on NASDAQ, Amazon Fire, and Roku. So be well. I can't wait to see you again next week. Take care now.